The dream goal of a large group of investors is passive income. In other words, income from invested funds that is not dependent on our work. My name is Nathan and welcome in the new video. It is also possible to achieve a regular annuity due to passive investing, but it's important to note that the value of the dividends is lower compared to hand-selected individual stock titles, where only high dividend paying stocks are concentrated. To achieve reasonable amount of passive income through index funds, you would have to have a relatively large amount of money invested in the first place. Dividend-tuned portfolio is an interesting investment approach, but I do not recommend applying through passive investing. With traditional index funds, the problem is rather a low dividend yield because you are investing in the average. For ETF funds, focusing on dividend investing, the main problem is the way in which the dividend income ETFs funds is taxed. Practically, all long-term capital market returns are calculated with reinvested dividends. For example, the S&P 500 has an average annually return roughly 10% when dividends are reinvested and only 7% when dividends are retained. The dividend yield of this index is around 1.6% at the beginning of the year 2022. If you have $1 million invested in the index, you would get only $16,000 before taxes for annual dividend. I do not recommend passive lifelong investors to go the route of high dividends yield. This is inefficient approach to building wealth. From the point of view of later income from investments, there is practically no difference between the payment of dividends or the income from sale of ETF funds. Therefore, choose mainly accumulation ETF funds for your portfolios. They also accumulate dividends in themselves. That is, they invest them back into the fund, which creates a snowball effect where reinvested dividends are gradually packed together with the growing market. I hope you learned something new. Bye.